Welcome everybody, it is Trade Live with IG. Piers on holiday, so I am very happy to welcome Imran back to the show. How are you doing?
Good to have, thanks for having me back, man.
It's great. Just for everybody that hasn't seen Imran on the morning show before, we used to work together in Credit Suisse. This man taught me all I know about options, and I remember getting myself into a proper mess over ThyssenKrupp as well.
Everyone's got themselves into a proper mess in options at some point or another, mate. Don't worry about it.
However, I will never forget the Eurostoxx. Now, what's the Eurostoxx trading at? 6,000, is it?
These days, my God, I don't even trade it anymore.
I think it's trading at 6,000. We'll check that. But I remember 2011 because it was around the time of the London riots. Remember there was like riots for a couple of weeks.
Mm-hmm.
And I was short the 2,000 puts on Eurostoxx, and it dropped from 2,400 to 2,000. And Naz made me cut it at the lows, literally right at the lows. Vol had exploded, and I was down $1 million, which, as a relatively young person at the desk,
it's enough. It's enough to be down.
Yeah, and that was it. Woomph, the market, up 6%.
Yeah, that's the trick, isn't it? You don't want to be in that position where you get the tap on the shoulder because you know that will always happen at the worst time, right? So the trick with options is like never selling naked outright options, right? Certainly not if you're like leveraged and you could be stopped out, right? So if you do like cash covered put selling, it's different, right? Because you've got the money to take delivery of the stock.
Just for everybody that's not an options trader, what does that mean, cash covered puts?
So cash covered put selling just means like, let's say there's a stock you like Tesla or whatever. Okay, it's trading at 400-ish. You're kind of thinking about buying it, but you're like not sure. You're a long-term bull, but you're like, at 360, I'll definitely buy it. 10% lower, I will definitely buy it, right? And I've got the money ready. I've got the money to buy it as well. So that cash, rather than deploying that cash here at 400, you just sell a put at 360. And if it ever goes down there, you'll get exercised and the money that you've got in reserve waiting to buy the stock, you'll buy it at 360. If we never get down there, you're just going to earn the income, the premium that you get for selling that option.
Like 2-3%.
Yeah, maybe you get a few percent, and then you just do that every month until you get delivered. So that's one way of, it's kind of like you're getting paid for your patience, basically.
Yeah.
Yeah.
And if you definitely want to own the stock, and you would have owned it anyway, right? If it does go down 10%, 12%, then you haven't lost the money on the stock going down.
No.
And if it goes down 30%, then it's exactly the same as owning the stock anyway, right?
Yeah, and like I said, you got in at a cheaper entry point, right? And you got paid to get in at that entry point because you collected the premium, right? Your risk is that your view turned out to be right, but you never got into the stock because the stock never dropped, and it just runs away from you. But if you're concerned about that, then some of the premium that you collect from selling those puts, you can spend that on calls or call spreads, which keep you in the game if it starts to rally, basically, right?
Now, we are going to, so that's one of the two basic options strategies. The other one, the covered call, we're going to cover in a little while as well. But what else are we going to speak about today, Imran? It's not just options, is it, for those people that haven't delved into that world yet?
We'll talk about whatever you want to talk about, mate.
Well, I want to talk about Bitcoin. I want to talk about the crypto crash, because we know you're an expert on crypto as well. And I think you've got a little idea for us in Alphabet. So we'll be coming up to that.
I still call it Google, but yeah.
Should we just call it Google?
Well, the ticker is still Goog, right?
Yeah,
so,
exactly. Yeah, I like that they got that. Welcome to everybody. Thank you for tuning in yet again. Peter, we see you tuning in from Surrey. You've got London Guide, Ida Rock, Matthew. So Matthew, did you keep your gold miners or not? Let's hear, because a nice recovery in gold and silver today. Let's just take a little look at how those futures are doing, because I'm very happy to say at last, for the first time since I started this show, I think, the portfolio is actually making some money. So, at last. How stupid did I want to look? Running a live portfolio on TV and for about 6 weeks actually losing money on it. Brilliant. S&P 500, 6,860. We're up 20 basis points there. The NASDAQ up similar amount. FTSE, though, new all-time highs.
Wow, look at that. FTSE.
Are you one of these? Do you even look at the FTSE now?
I'll be honest, I only really look at US indices. I don't look at a lot of European indices, but I look at all the US indices, so S&P, NASDAQ and Russell. And then I look at international. I generally look at international ETFs. So again, US listed ETFs that basically give you exposure to other like China and Japan and Europe or whatever, right? So I tend to keep it all within that US listed pot, basically, because that's where the liquidity's at, to be honest.
I tell you guys are sleeping. That FTSE 100, because not only do we have the FTSE up, we've got Vodafone up 4% today after selling, one of their businesses, Zonga, I think it's called, for £1 billion sterling. So is that going to be another potential buyback that they use that cash for? We don't quite know yet. So Germany up 0.5%, Europe up 60 basis points. They're performing well. Oil up 2.5%. That's recovering.
That's because they think there's some kinetic action imminent, right, between US and Iran.
Is that right?
Yeah, probability is rising by the looks of it. And if you
the
go
talks aren't going well.
Well, yeah, if you go on Polymarket, apparently the odds have been increasing that there's going to be some sort of imminent action.
I'm surprised the futures are all right then.
Yeah, I know. It's a bit of a tough one, but that's literally what I heard about an hour ago. Someone was talking about those odds increasing, basically. So.
Nice. Well, there might be. We're going to talk about volatility in the VIX index in a little while as well. So there might be something to do that. We might even put a trade on. Just jumping back in, we see the big recovery in silver today. I'm definitely going to need Imran's help on silver options that I've got on at the moment.
But you got some on?
I've got some on.
What you got on?
Ooh, it's been nasty. I'll explain the little journey that we've been on.
Oh, let me guess, you bought Vol 100 and it's just dripped.
No.
Okay.
No, sold Vol.
Oh, you sold Vol, okay.
But not before it went up. That was thanks to Piers. If you remember live on the show, Piers talking me into shorting silver at it must have been about $90 we put.
And then it went to 120, right? Yeah.
Up to 120. So of course I sold puts because that's what you would do, right? Short the actual underlying, sell some puts. Of course, as the future as silver dropped, then I took the profit on the futures position.
And you stayed short the puts?
Because I'd been so far off, and then stayed short the 75 puts.
Ow.
When it was 98. Didn't think it was going to 75, did I? And it was there within about
a day.
7 hours. And Vol wasn't going down either.
No, that's been a crazy one, silver.
Yeah. So that's been a lot of fun. And then we got Bitcoin not doing much. A nice rally in copper. I had a dream last night that there was an earthquake somewhere in the world that produced a lot of copper, and copper was up like 40% in a day.
40, oh wow.
Yeah.
Copper's a good one though. I'm in copper in my long-term book. I feel like copper's in a similar place to where uranium was like 2-3 years ago, in terms of the demand side is just exploding.
Yeah.
And there's not enough supply, right? And you saw what happened to uranium in the last few years, right? So I feel like copper's another one of those stories that in 2 or 3 years we're going to be looking back and copper would have easily doubled from here or something.
Let's just take a exact look at what uranium's done in that time. So it will be Sprott Physical, because now how far back?
Go back to like 2020, 2021.
Sure, that one's not given to me for some reason.
URA might be another way of looking at it.
Sprott uranium miners. I'm trying to remember which one. Maybe if we go into the US version, that might give me it, but I don't think so. No, but yeah, it's like you say, exploded.
Bring up CCJ, Cameco stock. It's like the biggest uranium miner. That would tell you the story. and go back a few years.
Tells it very well, doesn't it?
Where was that thing trading in 2020?
Oh my goodness me.
Yeah.
I remember being on a dog walk, 2021 it must have been, and reading about uranium, and I thought, yeah, I'll have a little bit here, up 20% within a week.
Yeah.
Sold it. you know, because I'm a genius, and it's now gone 800% higher. It's not been a one-way trade. It's had its
It's
dips,
a volatile beast, right? But it's that's the thing with these commodities. Like, once you understand the long-term supply-demand picture, you don't. I don't trade them like on a short-term basis ever, really.
Yeah.
These things, right? I try to identify where structurally there seems to be a massive disconnect between where the demand story is and how much supply there is, right? And then you're just like, okay, I'm going to allocate some of my long-term money in the pension or the SIP, the SIP or the ISA, whatever it is, into an instrument that will benefit from that, right? And that's kind of what I was doing in uranium. So like, yeah, I wasn't trading it. I was just more like, but now I'm still in it, but I have been taking some clips off along the way because it's just, obviously it's done that.
Yeah.
Yeah.
And so what about copper then? Copper now you think has the next 3 to 4 years ahead of it.
Yeah.
Be that similar story.
Yeah, because there's just so much with all of this, like, you know, AI data center demand coming through, electrification of everything, basically.
Yeah.
You're going to need so much copper to make that a reality.
And they haven't been investing in the supply.
No, they haven't, exactly. And it takes a long time for that supply to come online.
It has had a bit of resistance at $6 to the pound.
Which you would have thought it would meet some resistance there, right? But
Yeah.
like I said, again, I'm not really trading the short-term squiggles, right? I'm just like thinking a few years out, it's probably got a long way to go. And it's one of those where, you know, gold and silver have gone so nuts that you question like how much of that story has already played out. Some people still think it's going to 10,000, which it might well do, right? Gold, I don't know. But I mean, for what gold does, gold's done a lot in the last year, basically, right? So it's kind of, you know, if you're looking for value within the commodity sector, I don't think gold and silver are the thing that are screaming at you.
Can't argue that now, can you?
Yeah, not really.
It was really interesting over the last Fed meeting. That moving gold, I've never seen gold move like that before in my life, not even in 2007-8.
Gold's moving so violently, it's crazy. It's like, it's realizing double what it's implying, which is not normal, right? Like,
and just
implied's high, right?
So once again, it's sort of explain implied versus realized to the...
Yeah, so volatility is a measure of how much the asset's moving, right? But implied volatility is forward-looking. It's trying to anticipate how much we can move in the future. And option prices allow us to imply that volatility. That's how that's the whole point of options, right? Is to try and calibrate market expectations of what this asset can do in the future. Now, one of the inputs into that market expectation is what just happened in the past. So, and that's what realized volatility is, right? So realized volatility is backward-looking, and implied volatility is forward-looking. So we can just look at historic price data to calculate what realized volatility is, and then we look at option prices to figure out what implied volatility is, and then we compare the two. And then we've got to make a judgment call on whether we think we're going to keep realizing the way we have, or whether we're going to realize more or realize less, and then compare that to where the implied vol is to make a decision on whether we want to buy options or sell options.
Now, what does you can tell a story then, can't you, about the last 2 months in gold? And because you're saying, you know, it's realizing a lot more that's implied. How is that changing implieds going forwards? What's the prediction of what the next 6 months will be?
So implieds in gold like 6 months ago used to trade at around 15 to 20%. Okay, and the way you can convert that into something meaningful is if you just divide that implied vol by 16, that's roughly how much the market expects it to move every day. Okay, so a 16 implied vol means 1% a day. That's kind of what gold used to do, about 1% a day, right?
Up or down?
Yeah, and then we went a bit crazy and we started realizing like 50, which is more like 3% a day. Okay. And now I think the implieds are somewhere in those 30, mid 30 kind of range. So it's pretty much doubled. So now implied vol is saying that gold's going to, for the foreseeable future, gold's going to move 2% a day, right? But actually gold's moving more like 3 to 4% a day right now, which is insane, right? It's doubling what is implied. But the implied is already expensive, right? Because if you look at historically where gold implied trades, it doesn't trade at 35, it trades in the 20s, right?
Yeah.
So there's almost like a resistance in the implied vol. They're not letting the implied vol go higher because it's already screaming expensive versus where it normally lives.
And reverting to mean.
But yeah, because vol is a mean reverting type asset, right? But right now, gold just has no equilibrium in price, it has no stability, and it's winging around like a madman. So anyone who's long vol and long options on gold is partying right now. Yeah, they're loving it.
But what's causing that? Is it the appointment of the Fed chair, or was it before that the instability and the unknown around the Fed chair, or is it Iran, or is it the currency debasement?
I mean, look, I think the fundamental story in gold was there was a lot of things driving it, right? One, the geopolitical kind of concerns, the rotation out of treasuries into gold as a neutral reserve asset, where people like worried about their treasuries getting seized. So central banks in China and Russia were buying gold, stuff like that. But then the macro community cottoned on to the point that why are we parking so much of our safe, like low vol money in treasuries when treasuries are doing fuck all? We, pardon my French, we might as well allocate some into gold. So I think there was this big de-dollarization and this big rotation out of treasuries into gold. That was a real fundamental driver of this story, right? Yeah. But then I also think the options market played a part in the instability because there was some massive call buying going on over the last few years in that 4,000, 5,000 area on gold prices. And as we ran up into that, the whole street, i.e. the dealer community, was very short vol, right? And that when the street gets short vol, that makes things go a bit nuts, right? That creates more instability, basically. So I think there was a bit of a perfect storm there in that the fundamentals lined up and then we ran into a place where the street got very short vol. And that's kind of what we're digesting right now.
So, and if we can just go back to the chart, please, guys. So when the street's short vol, right, obviously those are products with expiry. So, and hence why it is mean reverting. But how long does it take to sort of wash through? Do you think we're halfway through this volatility storm, or what happens next?
I mean, I think now it's less compelling now. If you're like a macro trader, say you're a big hedge fund or whatever, and you've got a really bullish view on gold, right? Are you going to be as excited about buying a shitload of upside calls on a 40 vol as you were on a 20 vol, right? You're probably not, right? So then you might be more inclined to buy call spreads, right? And when you buy call spreads, you're not taking the street out of as much volatility, basically, right? No, of course. It's a more volatility neutral position. Obviously, there's different strikes associated with it, but the idea is that the net street position won't get as explosive on the upside if the end user isn't just buying loads of vol off the street, basically, right? So I think we've seen the explosion. That doesn't mean we can't go up again, but until vol resets to a level where it's attractive to then go and just buy a load of outright vol again, you'll probably be a bit more balanced, I would have thought, in terms of that.
And in the case of silver, so obviously normally in equities world, when markets start to drop, vol generally increases, right? But in gold and silver, as they start to fall, could volatility come down?
Yeah, generally that's the correlation in commodities, right? It's spot vol is correlated with a positive correlation, whereas in equities it's a negative correlation, right?
Right.
So, and that's generally because in commodities you have these supply shocks, right? And when you get a supply shock, commodity prices spike and they spike quickly, right? So apart from like oil, that sometimes has a bit of a negative skew, quite a steep one, because it's like, it's kind of, impacted by the economy and stuff like that, right?
Yeah.
So in a big risk off where it's economic concerns, oil will start crashing hard as well. But generally, most other commodities are going to have a positive skew for calls because their real gappy sort of price action happens in supply shocks. Yeah.
Got you. Fantastic. Right, if you've got any questions on any of the products, whether it's options, whether it's volatility, whether it's gold, then be sure to get them into the chat here. I'm very happy to take in your questions. It is, as Stringy says there, very educational show today. Yeah, because Guru Piers isn't here, is he? You don't really like the term guru.
Oh
do
my
you,
god, I
Imran?
hate the term guru. I got called the vol guru the other day, and I was like, I hate that word. Stop that. Yeah, because it's just, my goal isn't to like predict the future and get everyone to copy me and follow me and stuff. It's to teach you the fundamentals and teach you how to think for yourself, and then go out and hunt. Basically, trading's like, it's like hunting, right? We're all hunting for P&L, basically, right? And my job is to give people the tools to like figure out how to do that for themselves. If they want to go and trade silver all day, that's what they want to trade.
Yeah.
I'll teach them some techniques that help them do that, and they can go do it. I don't want to stare at the silver chart all day, right? So trading's a very personal thing, and people need to realize that, and kind of they need to figure out their own personality and psychology. They need to see what they're interested in trading, and they need to learn the skills to do that effectively. And people like myself are there to provide that education. But I hate the guru culture, yeah.
Well, it's very funny. So I've been at something this morning which is top secret. It will come out on Saturday during the rugby. There is something that IG have been producing for a couple of months now at least, and very exciting. It's the first time they've done it, and I can't say too much about it, but false gurus is definitely one of the topics involved in it.
I'm interested to see that.
Yeah, you'll have to wait until Saturday to find out, but we'll certainly be talking about it next week. Right, what time are we on? We're 22 minutes past 2. So
About Bitcoin.
yeah, I think we have to, don't we? So Blue Dash saying gold seems to have taken on Bitcoin volatility as the demand scarcity is increasing. Let's talk about Bitcoin and its volatility and its collapse.
Yeah, so Bitcoin's been super interesting over the last year, right? So you had this big wave of institutional adoption where, macro portfolios decided to allocate into it. The ETF inflows exploded. And the price did reach quite decent levels, right? It got to 126K back in October. But then for whatever reason, you had this big liquidation event later in October.
Yeah.
And
Brutal.
you had, I don't know, I think one of the triggers was quantum threat, basically. People got a bit concerned about this quantum threat and what it means. And basically, it unlocks all those old coins that Satoshi apparently holds, 4 million coins that could essentially get unlocked that would then get sold onto the market. Okay, that's kind of what the fear is around the quantum threat.
I didn't know that.
Yeah, it's to do with unlocking Satoshi's coins or something, and it's
Essentially increasing supply, right? Because the theory is that, all right, they say there's 21 million, but it's not because you've got Satoshi's locked up.
Something like that, yeah. So it's so the market's trying to price that threat, basically, right? And then at the same time, you got all the OG long-term holders decided, okay, above 100K, I'm out, yeah, because they've been in there since 1K or something.
Yeah. And they believe that this ridiculous cycle still exists.
Well, yeah, there's the 4-year cycle, but there's also the mentality that, when OGs got into crypto back in the day, part of it was an ideological thing, right, around why they were doing it. It was a revolt to the system, right? But then now it's becoming financialized with the ETFs and stuff. So it's just part of the same system. Yeah. So some there's a theory that, a lot of these old people who invested in it are just well, it's not what we thought it was anymore. And we've made 100x on it. Let's get out, right?
I go for their old-fashioned greed on the 100x thing more than the,
the ideological thing.
Yeah, because where are they going to go, right?
With gold. They go physical gold, right?
Yeah.
Maybe they are going physical gold. That's why it's going up so much.
Yeah.
But yeah. So anyway, so that was kind of the narrative. And the truth is, what was the use case for Bitcoin? The biggest use case that everyone was banging the drum about was digital gold, scarcity, currency debasement hedge. That was the story.
Yeah,
because
I believed it.
And the truth is and it was so clearly the story because if you looked at the alts and Ethereum and everything else, they were in the gutter, right? So they were not rallying in sympathy. So it wasn't crypto's going to take over the financial world and this whole new ecosystem is growing and all this stuff. if that was the case, we would have had an alt season, right? But we never had an alt season. We had only Bitcoin dominance growing, Bitcoin going to new highs, all these inflows coming in, and everything else was doing not a lot, right?
Yeah.
So that was the story. But then in the last 6 months, we've seen if it's digital gold, why the hell is it doing what it's doing? It's horrible, right?
Yeah.
So the price action has been so utterly miserable, right? That anyone, and you know, I'm not like it's not for me, it's like just another trading instrument, right? I don't believe in it as like a religion like a lot of people do.
No.
Yeah?
You're the same as Sosnov. Sosnov just says, give me whatever, I will trade it. If it's got a vol and a price attached, I'll trade it.
100%, right? So I got involved in 2020 when it was trading at about 8 to 12K, right? Obviously, it then went on to like a lot higher. So happy days.
That's the same as me.
But now it's like, if it goes back to zero, well, not zero, but let's say it goes back to 10K, okay? I'm going to try to, you know, trade that move just like I would trade a move to
180.
Exactly.
Yeah.
Right. So for me, that's I think you've just got to be honest when you look at that chart. You look at the price action. It's like all the fundamental reasons and narratives to be long it are not being proven correct because it should be trading correlated to gold and it isn't. Right. So there's something else driving it.
Yeah.
It's going to have these periods, episodic periods of volatility that are great for options traders to take advantage of. And you trade the swings, right? And that's what I'm kind of trying to do. For me, until it gets above 75K, it's a sell the rallies market right now.
Well, and it's proven to be every time so far. If we just take a look maybe closer in, let's go back a little bit further. As you can see, every time it's tried to get back above 70,000, it has not managed to hold it. And it has been sell the rallies very clearly. I'm not sure what the catalyst is that to see it get back up.
Yeah, and usually, narrative follows price, right? So when it does finally go back to 80K, we'll suddenly know what the reason is.
Yeah.
Okay. But at the minute, I would say it feels to me like it's much more likely to retest the lows, right? I want to see it retest the lows, but I want to see it do that in a less explosive way. So I don't want to see volatility spiking. Like when we saw that move 2 weeks ago, volatility almost tripled in Bitcoin, right? Implied volatility, front end, right? So it went from like 30, 40 to like 100. So that was nuts. And then put skew, which is another barometer of kind of the market's perception of risk. But implied volatility is the perception of how much we're going to move, agnostic of direction, right? But skew has got like a directional bias to it, right? So like we said, commodity skew is usually priced for calls, equity skew is priced for puts. Crypto volatility skew is actually can go both ways, right? And it's a bit more fickle. Like when we're rallying a lot, it gets priced for calls. When we're selling off, it gets priced for puts.
The momentum.
Yeah, a little bit, right? Because there's a lot of speculative users who pile into options to try and play it. But anyway, the put skew, which normally trades in a range of, let's call it 0 to 10, went to 30, right?
Wow.
So, and I haven't seen that since the FTX collapse, basically.
Yeah.
Right? So it went very extreme. And then it's reverted all the way back to like 5 again, right? So, I mean, it doesn't take long for it to normalize.
Which makes sense because the upside, it's a 50-50 whether we explode up or explode lower.
Yeah.
We are now 20 seconds away from the US Open. Imran, would you do the honours and ring the bell for us with our bull from Boise, Boise's bull, and we'll have a look at what's going to happen. I fancy it is a positive open so far, and you've got about 7 seconds there, Imran, to until we are going live.
1.
There we go. So, what have we got moving today then? It is Moderna out of the traps, the top performer up 6%. That one's been volatile the last few days. Palantir up 1.7. We're short puts on Palantir, so that's something you're going to help me with shortly, I hope. Nvidia up 1.7, back up to 188. Nvidia's been decent, hasn't it?
Earnings next week. It's a big one.
Oh, of course it is.
Yeah.
Jeez, I'd forgotten about that completely. I'm trying to move house at the moment. Well, I'm trying to get a house to move to.
I moved house 2 weekends ago.
Oh, really?
Yeah.
Must be the season for it.
Yeah.
Yeah, so Nvidia 188, earnings the 25th, is that right?
I think so, yeah.
So we are a week today. Woohoo!
Yeah.
Right, clear the diary. We've got, Citigroup up 1, Home Depot, Amazon up 1 despite Buffett selling his stake. What is it Buffett anymore? I don't know.
Yeah, but that's, I mean, it's kind of old news though, right? It's like when that sort of news hits the tape, it doesn't necessarily mean much for the stock at that time. Do you know what I mean?
Yeah.
I mean, we should probably talk about Google, right? You know, we said we were going to mention it.
Well,
So a lot of these Mag 7s have been getting sold since the start of the year. There's been this big rotation out of Mag 7 into value stuff, basically, right? Real world stuff, well, you know, real atoms as opposed to digital bits, basically.
Yeah.
Right? But I'm kind of sniffing out that we might have a tactical buying opportunity in some of these names now.
Brilliant.
Yeah.
Well, I tell you, well, let's come on to that in a second. Just after we look at the losers, we'll go straight on to that. The airlines are the biggest losers today, down 3.5%. Haven't seen a reason. I guess oil being higher, perhaps. Maybe that chatter on Iran is taking those down. But those, or we might have had numbers. I will check if we've had numbers there. Home Depot down, Meta down 1.3, Broadcom down 1.3, Intel, old favorite, back down to $45 there. And Walmart, at last, I'm also short a bit of Walmart, Imran.
When is it? Haven't they got earnings coming up? I feel like they have, but maybe they've already had it.
I should know that with a position in it. But I fancy that they're still to come. And I would imagine that's probably why people are taking a bit of profit there. So let's have a look at, that's their worst day yesterday in 4 months. So I managed to get short them.
The staples have been killing it, right? Yeah, the staples have been killing it again on the rotation out of, you know, tech and momentum type names. Because I've been trying to sell McDonald's, right? And I mean, it hasn't cost me a lot, but it hasn't really worked for me.
Yeah.
So yeah, some of these staples do look a bit toppy though. They do look a bit expensive, right?
So this is up. Since the 20th of November, it's up 27%.
So you just shorted stock. Where did you sell the stock?
Where that little white dot is.
Oh, okay, yeah.
Yeah, let's have a little. It's not often that you get that. Boom. So that was nice. But I'm going to take profit on that soon because I think they might have numbers this week. Numbers tomorrow.
Oh, they have got numbers tomorrow.
Tomorrow.
Okay. You know what you could do though? You're up money on that, right?
Yeah.
You could switch some of that into puts. So you take profit on the delta that you just traded, right? And then half of what you've made, if you're bearish the stock, half of what you've made, you spend it on some puts for earnings. And then, but the problem with spending on puts for earnings is the implied move is probably 3 or 4%. So you're not going to make money unless it drops 8%. Do you know what I mean?
Well, I'd happy to be doing a 1x2 or something like that, though.
Yeah, you could set up a put spread, flies are the trades that I love doing for earnings, basically.
Right, we can see at last, people, we're making money on the portfolio. It has been, I think it was down, at worst, it's been down 4.5%. So we work off 100,000 as the capital in. It was down 4.5%. It is now, well, what puts, I am up 2,000. So we're up 2% now since inception, with a total of 102,000 and a little bit. And where's that money coming from today? Well, it is the bounce in silver. We've had a nice bounce there. So we've made money in being short that $75 put. That is for March, Imran. What do you think about, obviously I can close these two because they're priced at 10. So would you always close being short calls 30% away from the money?
Yeah, well, you're not earning any theta on them anymore, right? Like, the whole point of being short options is to earn time decay, right? Generally, right? I.e., when that premium goes to zero, you make that money.
Yep.
Those aren't really going to go any lower. Like, how much is that 10? What is that 10 worth in terms of actual money?
So that will be worth what, a third of 50s, 15. It's about $180.
That's what you've already made from it, you mean? Or
No, $180 is what's left in it.
$180.
Yeah. So do you keep that or do you just take it off the book? I mean, silver's not going to 100 in the next couple of weeks.
Yeah, I mean, for me, it's just
In fact, there's only a week left in this thing.
Yeah, I mean, the problem, now see, contract size.
Expiry 24th. Yeah, so next Tuesday. Does this keep it?
I
So
mean,
0 to 10.
this is the problem, isn't it? It's like, I mean, there's no real chance it's going to go there, but you're right. It's kind of, you're crossing that bid offer spread,
Yeah.
right? But if it's, I'm surprised you said it's 200 though. Like it would cost you 200 to buy it back, paying 10.
No, sorry, we're short.
I'm saying if you pay 10 to buy it back, how much physical dollars are you paying to buy it back?
So it's $50 a point.
Yeah, but you don't
And
even have a point. You don't have a point on. You have 0.3 on, right?
Yeah, so I'm going with roughly $16. So $16 times 10, 160.
Oh, okay. So it's still $160. Okay.
Yeah.
Yeah. Problem is that's not insignificant to what your P&L is, I guess, right?
Correct.
Yeah.
But look where it got to. It got to 2,000. I mean, that tells the journey in silver, isn't it? We're talking about, oh, do I pay 10 for it? It's been at 2,000.
Yeah.
So anyway, we'll keep that on just now. Microsoft, I have got a covered call. So do you want to just roughly explain what a covered call? You can see there it's the March.
You own the stock and then you're short calls against it, yeah?
Exactly. A little bit more, I'm sure. Yeah.
You're short effectively 100 shares worth of calls, but you're only long 60 shares.
Yeah. So what is that position? What am I saying? What am I trying to represent in a covered call?
So you own the stock, you like the stock down here. You probably got, where did you get it? At like 400-ish?
415.
415. Okay, so it's gone a little bit lower.
Yeah.
And then you sold the 420 calls
Afterwards.
after, just to try and get some money back, basically.
Yeah.
Okay, and allowing yourself to be patient for it to bounce back, but getting some money through the door, basically.
I think it had already dropped to 405, and I was like, oh, well, this position's gone wrong. But I'm not selling Microsoft at 405.
Yeah, so you'd rather manage it rather than dump the stock and stop out, basically.
Exactly.
Yeah, that's interesting because you know the traditional covered call strategy is more you're a stock picker, you've picked the names that you like, you've built a portfolio, and then you're trying to enhance it with a bit of yield generation. So you like say, okay, well, I like these names, but Microsoft isn't going to rally more than 5% in the next month, so I'll sell those 105% calls and nick a bit of extra premium out of it while I own a stock that I like. You didn't really do that in this case. You actually bought the stock, it went against you, but rather than dumping the stock, you said, I'm going to use the short call to buy myself a bit of time, right? I'm going to earn premium. And now if the stock rallies straight back through 420, then I don't have the stock anymore.
And
right?
the whole thing was a bit of a waste of time.
And the whole thing was a waste of time, but at least I didn't lose money.
Yeah.
Right? But in the meantime, as the stock digests the move lower and eventually recovers, the premium that I got from the calls kind of cushioned the blow a little bit, basically. So that's kind of how, that's probably the rationale there for what you did.
That's exactly it. And we can even put it into numbers, right? Because, excuse me, if this, if Microsoft stays below $420 until March, you can see there, I'm short one contract at 770. So I'm just taking in $770. Right now, my P&L on the underlying stock, I'm down $1,000. So instead of being down 1,000, if Microsoft's still trading around here, I'm only down $250.
Yeah, that's right.
And that's kind of what I'm trying to do there.
So it's a kind of loss management exercise. But you're okay. But then let me ask you something. Then, what happens if the stock goes down another $20? Right? What?
Buy more.
Texas hedging.
What do you think? Because look, we're at a crossroads in the market at the moment, aren't we? That it believes in software, or it believes in AI destroying.
Yeah.
These
I mean, the software stocks do look oversold here, right? For sure. I mean, I picked up some Adobe last week because I thought Adobe was due a bounce, basically. Yeah. Where is Adobe? Can you bring it up?
Yeah, certainly. You still got the position.
Yeah, it's just a call spread. But I always, if I'm going to catch a falling knife, I'll do it with options, right? I won't generally just do it with stock.
Yeah.
I'll only buy stocks that I believe in for the long term, that I'm willing to just sit on for like months, if not years, right? But if I'm trying to play tactical, like dead cat bounces from oversold and stuff like that, I'll structure an options trade usually.
Nice.
Yeah.
Well, I mean, that is a dead cat, right? Is it going to bounce?
Yeah, that's a dead cat. Well, the options market is pointing towards a bounce, right? So there's certain metrics that we follow in the options market, right? So I've got this framework that I've built to help me identify directional trades. So the first starting point is obviously you're looking at the technical setup, right? You're looking at the chart and you've got various indicators you could use to identify if something's overbought or oversold. But that's not enough, right? Now, I mean, think about the whole planet does that, right? There's no real edge in doing that. But that will at least draw your eyes to an opportunity, okay? Now, what I then do is I then apply another lens to it by looking under the hood of the options market, right? So there's like 3 factors that I look at. I look at what the volatility market is doing, so what we call it the fixed strike vol, right? So what the vol surface is doing in the stock as it's approaching this kind of important level, basically, right? If that volatility is rising, it's giving you an indication that the dealers in the options market are getting taken short volatility, right? Or they're certainly not very long, okay? If that volatility is dropping, it suggests that they are long, okay? If they are long, then you're more likely to see mean reversion of the move, right? You're not going to see an extension of the move necessarily.
Yeah,
right?
because there's no panic.
If they're short, then you could see a massive extension of the move, right? So what I'm looking for, if I'm trying to play a counter trend bounce, I want volatility to be compressing into that move, right? Or certainly not gapping higher, right? Then I look at skew. That's the second metric. Is the skew moving? Is it pivoting towards puts or calls, right? If I'm starting to see a market making new lows, but the skew is moving away from puts and towards calls, that's another counter trend signal suggesting that some options players are coming in and hoovering up some calls because they think there's a bounce coming as well, right? So we look at the volatility, we look at the skew, and then lastly, we look at option positioning. So we look at the open interest landscape in the options market, and is that shifting, right? Because that's a constantly dynamically moving surface based on where price is and then what option players are doing to speculate around that price. So if we're going down and the put open interest is rolling lower, what that means is people who own puts are monetizing those and rolling them to lower strikes to keep playing more continuation of the move, right? If, however, they're not doing that, or they're monetizing their puts, or they're just leaving them, then if we overshoot through those puts, there's a good chance we're going to bounce back, right? And that's
pushing the ball underwater.
Yeah, so it's they call it put walls or call walls. That's the common sort of terminology people use. So if those walls are not shifting, then they give you, again, that gives you more confidence of a mean reversion, basically, right? So I'm looking at all these other factors as part of my framework at Options Insight to identify these opportunities. And then if all those stars align, then I'll go in and figure out which option trade I want to do to try and participate in it. Yeah.
Was that some of your Twitter article that you moving from?
Yeah. I explained the reasoning behind that methodology in my Twitter article. That I just published this week. Yeah.
Here we go. So where do people find you on Twitter, Imran?
So my handle is options_insight. I'm posting daily these days.
God, that photo's from a few years ago, isn't it?
Before the beard, yeah. yeah. I look very corporate in that picture. I don't like that picture. But so, posting articles, posting like educational content, basically, to help people understand this space better,
Got 24,000 followers. Go on.
Yeah.
That's nice.
Heading in the right direction.
Good stuff. And yeah, you can see, you're getting good traction there on. That's just from recently, that article. And then what about finding you on your website as well?
So that's options-insight.com.
There we go.
So we got two main things that we offer, right? From educational perspective, we have a course, which is and that course is always evolving. Right? I'm adding content onto that course as we go along when I come up with new stuff, basically. Like this framework that I've just discussed around how I identify directional trades, that's some new content I'm going to add to the course over the coming months.
Right.
But basically it's an off the shelf, you pay one fee and then you get lifetime access to like 13, 14 hours of video content, basically, right? And then you also get access to our community. So you get 3 months free access to our community, where we have like a global community of traders. It's kind of like I kind of think of it as an online global trading desk where I've got all these. I used to run desks, right? I used to run desks at BAML and City and stuff. And that was me plus maybe 3 or 4 other traders, right?
Yeah.
But this feels like the same thing done virtually with like hundreds of traders, right? So I've got all these guys who I've kind of educated around these concepts. They're all looking at their own stocks that they like and what they're interested in. They're all reading their own research and stuff. And then they're coming back to me and they're saying, what do you think of this trade? What do you think of this trade? And I'm giving them my guidance, just like I would to the juniors on a desk around what I think. And yeah, it's really cool because a lot of time they're presenting me ideas that I haven't looked at, but then I see it and I'm like, that's a great trade and I'll pile into it as well, right? So there's that camaraderie of a trading desk, which is quite cool.
This reminds me, so how many in the group, roughly how many people?
Oh, it's like 120 or something, yeah.
So this reminds me of that moment in Anchorman. And you know when there's the different TV crews all coming into, and they have a fight? Well, Piers' Apex Army, right? It sounds like, you know, they've got all their guys and then you've got your guys. If everybody puts their ideas together, puts their heads together, we can take on that Wall Street crew.
Yeah, it's about exactly like if you approach the market from a completely different perspective as someone else, but you come to the same conclusion, your conviction just doubled, basically, right? Do you know what I mean? So I think that's the goal.
Or there might be a clever way to play it. Instead of buying stock, short in stock, is there a less risky way for more upside in the options market?
Well, yeah, the whole point of using options, which is what I'm trying to, you know, get through to people, is that they give you asymmetry in your portfolio, right? Whereas just trading stock, long and short, there's no real asymmetry there, right? You know, it's a linear delta one expression of your view. Whereas options give you that ability to have non-linear, right? Where I could lose 1 or I could make 5, right? And if you express your views like that, and you do it time and time again, generally, the idea is you only need to, if you're right 50% of the time, but on your winners you're making 2 to 5, and on your losers you're losing 1, what do you think your P&L is going to do?
Happy days.
Yeah, exactly.
Well, talking about P&L, we are on fire today, people. So this is, as I say, sometimes you feel like a portfolio is working, and one idea is just to go and expand all the positions and take them bigger, because this is really starting to work now. You can see we're up another 600 since the market opened. So to continue going through, Netflix, I'm short the $73 puts in Netflix. Trading around 75, 76, I think.
That stock's been beaten up, hasn't it? I mean, it's all about this merger, right? It's all about, it's all about this takeover. Like, market wasn't a fan, was it? They thought they were overpaying.
And so, well, it sounds like they might even have to pay even more. but because Paramount coming back to get involved. What on earth do you do with a stock that is as good as Netflix, as good a business, but it's going into this potential merger situation or M&A, and it's 70-30 probability that they end up getting this deal, and it's going to be expensive, but the stock's already, in theory, priced a lot of it in. Yeah. What do you do in options?
Well, I would have to have a look under the hood on this one, right?
Yeah.
Which I don't have my laptop here connected to be able to do in real time, but another time. But I'll tell you what I will do is I'll have a look under the hood and I'll put it on Twitter in the next day or two. I'll put a post on Twitter going through Netflix and telling you my thoughts.
Good man. So we've got the position there, and that's kind of like this idea of what you're talking about, the cash funded put, because I want to buy Netflix, right?
Right. You want to own the stock.
I'll happily buy it at 73 minus the $2.
Yeah, so you collected close to 3% there, basically, right?
Yeah.
Yeah.
Oracle's come back a bit, not doing great things. It was so exciting when it was up at 163, but 153, I could do with just that getting back up towards the 160 level. Palantir, little bit of a mess here, right? Got myself, first of all, I shorted the 150 puts.
You love selling options, don't you?
I do.
You love it.
As a Scotsman, it's just...
But it is the systematically right thing to do, generally. You don't generally want to be buying options, right?
And I'm from the Tom Sosnoff school as well, so...
Yeah, true.
But can I tidy this up? Because I'm short the 150s for March, and I'm also short the 120s. right? But I'm at the same time on the call side, I'm short the 165s and 175s. So,
I mean, generally, like,
and the stock's 136, 137.
the stock's blasted through the 150s, right?
Yeah.
Yeah, it's they're in the money. But like, what's the deal with, like, are you thinking you would buy the stock at 150 or not? Or would you take delivery or not really?
Not at the 150. If it was down at 120, I'm very comfortable.
Yeah.
At 130, I'm like, it might have a trading bounce. I don't like
I mean,
it anymore.
what you could do is you could, to manage your risk a little bit, because obviously you've gone in the money on those 150s, right?
Yeah.
You could roll those down to the 120s, increase your size on the 120s.
Yeah.
But you'd need to probably sell a few more of the 120s really to get any premium back, because they're worth 260, whereas these are worth 1500. Right?
Exactly.
Yeah. But then what you could do is say you roll it 1 by 2. So obviously you are going to take a bit of a hit. You buy the 2 back, you sell 4 of the 120s, right? So you've rolled that risk down a bit. You've taken some of the loss, but then in a bounce in the stock, like bring up the chart of the stock, but in a bounce in the stock, you can then sell some more calls basically.
Well, it's up 4% today, so
you already got a bounce. In the stock.
this might be the bounce. Okay. However, we now have April. April's just been listed. There's not too many of them there, but there's the 125s. Now, I can sell the 125s for 575.
Yeah, exactly. Which is a third of what your other ones are costing you, basically, right?
Yeah.
Yeah. But the problem is you don't want to get into this trap of rolling and increasing your size every time, rolling and increasing
That's dangerous.
Because you're asking for a blow up, right? Like, what if the fucking thing goes to 100?
Yep.
You're gonna do your conkers, right? So. And it's funny, actually. Should we talk about Captain Condor, because that reminds me of the story, right?
Oh, well, I tell you what, you were I rudely interrupted you when you were about to give us an idea on Alphabet.
Oh yeah.
So we'll do that. Then we'll go to Captain Condor. Okay. First, I'm selling two of these, and I'm going to buy back one of the.
Yeah, that's not a bad risk management strategy.
Okay, so there we are. We're shorting 200 shares of Palantir puts, right? So shorting 2 contracts of the April 125s. I will then go and buy back one of these ones that I messed up, right? Now I'm paying 1,550 for that.
Yeah, so paying about 500 for the structure, basically, right?
And paying about 500 for the structure.
Yeah.
But I originally shorted them at 585 anyway. So I'm giving up what I originally was going to potentially make. So,
but you're adding a little bit more risk on the downside to buy an extra 100 shares if it drops through 125. Right? Yeah. So that's the risk, right? So it's one of those though. You can kind of lean on that a little bit, and then if we rally another 5% in the stock, maybe you buy a lower strike put in April, turn it into a put spread or something like that. Do you know what I mean?
Yeah.
There's all these sort of little tricks that you can do. You don't have to. When you do a trade, you don't have to be married to that trade. Right? You can tinker with it. You can move it around. You can be opportunistic when the stock swings around, basically, right?
Yeah.
So Alphabet, Google.
Alphabet. Let's have a look.
Bring up the chart.
At Google. We said we call it Google, didn't we?
Yeah.
So I think we're about to go through the first ever time that we've gone through without a break on this.
It's too much to talk about, mate. It's too much to talk about.
It's always Piers always needs to take a break. That's what it is. Right, Alphabet.
Lightweight.
It's come off, hasn't it?
Yeah. So okay, this is the crazy. I mean, this uptrend in Google is impressive, right? Because Google's been stealing market share from OpenAI. People are loving Gemini. I mean, I love Gemini. I use Gemini, but I tell you what, I love even more. Notebook LM. Have you ever used it?
No.
Oh my gosh. It is unreal.
What is it?
It's basically a Google extension, AI extension. So it's like powered by Gemini.
Right.
But you can upload all these sources into it, right? Source documents, source YouTube videos, whatever it is, information sources.
Yeah.
And you can basically create all kinds of stuff using these sources. So for example, you could upload a 100-page document in this thing, okay, like a research report, deep dive research report from a bank or whoever. And then you click a button and it turns it into a 20-minute podcast of two people speaking about this topic in an engaging way that you can just absorb in 20 minutes, right? Like a podcast.
My job's dead.
And it's all AI generated, right? You can create slide packs, you can create videos, you can create infographics, all with a click of a freaking button. Unreal. I'm using it a lot to like create content around my educational stuff because it's just so damn good. But yeah, so Google's killing everyone with this sort of product, I think, right? But anyway, back to the stock.
Yeah.
So it's had a good pullback from the earnings, right? It touched to 350, back to 300. Now, you know what I was saying about looking under the hood of the options market, right? So technically, we're at a great correction level, right? Very close to where it bottomed out earlier in December. So that's an obvious place for this correction to play out before it resumes the uptrend, right? Just on a pure technical level, right?
Makes sense.
But then under the hood of the options market, what am I seeing in volatility? No bid. Volatility is not bid on this drop. That last drop from 320 to here, no bid in volatility, right? So that says to me, okay, market's not scared of this thing really cracking lower, right?
Yeah.
What else am I seeing? I'm not seeing the puts at 300 roll down to 280 or anything like that. So the put wall is staying at 300 right now, okay? The only thing I'm not seeing is the put skew fading towards calls, right? So if I see that, then that's my golden signal to say, okay, this thing's ripe for a bounce. Yeah. So that's what I'm looking for. Yeah. But we're close. I mean, 2 out of 3 are there, plus the technical setup looks great. So you might want, what you might want to do, or what I might even do, is I'll buy a call spread here, and then once I get the put signal, then I'll just sell some puts as well, just to get some premium in the door.
Okay, so you actually spend, first of all.
Yeah, spend now to keep it safe in case the bottom's not in.
Yeah.
And then once I get the signal that skews pivoting as well, then I'll slap some puts out maybe. Because if I don't mind taking the stock down, I'll only do that if I'm willing to take the stock down at like 280 or whatever, right? So.
What expiry?
I mean, generally with this sort of thing, because it's such a strong uptrend I'm trying to get into, I'd probably go a little bit longer dated. So I'd go like 3 months or something, right?
Okay, so April 17th expiry.
Minimum April, but if I could do May, maybe I'd do May as well. Like, I'm in some Tesla call spreads to May right now, so I'd probably go a bit longer if I could.
Let's have a look at where that's trading now. So with the price at 303, we've got, and we think it. I mean, where can it bounce to? Back to the highs?
330 easy, right?
Do you think?
Yeah. I mean, it depends, right? You know, you give it time. That's why I don't think it necessarily gets to 330 in a week, but in 2 months, like, could easily get to 330, right? It's Google.
Yeah.
Right?
Yeah. And it will have another set of results by the 17th of April.
Oh, is that right?
I'm trying to work out if it will, because we were the last.
Probably end of April.
Yeah, it is.
End of April, early May. The earnings on tech will be around that sort of time, yeah. So that's another reason why you might want to go in May, because what you can do then is if you own optionality that captures earnings, that optionality trades expensive, but it stays expensive.
Yeah.
Yeah, because it contains the event, so that the options don't decay as much as they should do, often, right? So that might be a good expression to like own, you know, if the stock's here, maybe you own the 320, 350 call spread to May, and it actually decays quite nicely because it captures earnings. Right.
All right. Shall we do something then? We'll let you leave your prints on the show. I'll put on something like, what about a 315, 340?
That costs around 7 to make 25, right? So you always want to think about it in risk reward terms, right? So it can make 25. You're paying 7 for it. So you're paying 7 for an 18 potential profit. Basically.
1 by 2?
No, don't do 1 by 2.
No,
You want something with delta. You want something that actually will increase in value if the stock bounces hard from here, basically. 1 by 2 won't do you any favors if that happens, right?
Of course.
Yeah. So 7 to make 18 is a little bit better than 2 to 1. So that's okay. I'd probably push the strike up a little bit more and do the 320, 345. Okay. Because you're getting into that close to about 5. So then you're in it for 5 to maybe make 20. So you're getting almost 4 to 1 payout if the thing just roofs it, right? And like I say, that thing's going to decay really nicely because of that the way oh well no, but that one won't because it's April.
that's
That
April,
doesn't capture it. So I'd rather do May. So maybe wait until May comes on the board, right? But
Okay.
if you really want to trade it on, you can. But like,
Well, I like the name, and I have wanted to get involved, but I would mess it up. Like you say, I would do a 1x2, and then I would probably sell the put already because I don't have your wealth of wisdom.
yeah, it's the sequencing, right? A lot of the times the edge is in the sequencing.
Yeah.
Because it's like, you know what trades like, for example, someone of your experience, you know what trades kind of make sense, right? But you don't think through the right sequencing to manage your risk optimally, right? So it's like, right now, the only thing I would do here with 2-3 months to go till expiry is do something with a bit of positive delta on it, and just like the call spread, okay? But the beauty of that is once I'm in that trade, if we go lower and we get that signal that I mentioned on skew flattening, then you can still sell the put at a later date and bring in the premium a bit later at a lower price point, which means you're getting a better entry on the put because we've gone down, right? And then if we rally instantly and you're already making money on the call spread, then maybe you sell that extra call that you wanted to sell.
Exactly.
Right? And so you can trade around the position that you start with to end up with the position that you would have done on day one, maybe.
And at far less.
Yeah, a better entry, a better price. Yeah, exactly. Yeah. But this is quite high level stuff, right, to do it that way, right?
Right, so let's buy one. It keeps on jumping. Every time I go to buy it, Elliot Harris is across there lifting.
It's telling you to wait till May's on the board.
Okay, right.
Wait till May, trust me, wait till May.
But it's a good day. Well, we've made another 500 here. This is a cracking day here.
I think there's someone put something on the chat for Google just then. What was that?
Google Next report, 23rd of April. Perfect. Thank you very much, Neil.
Yeah, so you need to trade May to capture it. Yeah.
Capture that.
It'd be good to get some comments from people on all the stuff we're talking about.
Yeah, definitely. Yeah, please. And what I would really be interested is getting Imran back in to do a 3 people round the table with Piers. So on this, obviously Piers' idea, then Imran looking at the options market, and then we can all look to. I'm sure there'll be some that we'll all argue are different.
Yeah, because there won't be confirmation coming all the time, right? But there'll be some where, what he's seeing on his side and what I'm seeing, they kind of back each other up, and then it'll be like, fill your boots.
I look forward to that.
No financial advice, of course.
Yeah, absolutely not. Never.
We'll just fill our boots, right?
That's what it is. My VIX trades just come off. I was wondering why the P&L was changing there, but
where's the S&P right now?
S&P is rallying 6887.
And where did the VIX print? Where's the VIX spot right now?
We are VIX. The VIX index is 19.9, but that's not.
No, that's where. Is that where? That where it expired?
No, because that's a blend of two different contracts. Just to finish off the report on the portfolio, of course, we won't see it until next Tuesday. Still long, Relics doing all right. It hasn't moved today. Robinhood, we're getting a kicker today, so that one is up strong. Love Robinhood there at $75.
It's been hit with the crypto space, I guess, right?
It's been smashed, and then the numbers, they were down 12% on the day of numbers as well. So it's had a real kick in.
Coinbase, similar story, right? Yeah.
Uber has had a decent bounce today as well, and as I say, short Walmart, we're going to take that off now. So ahead of numbers tomorrow, take the money on Walmart. So I think that's us. What is it? It's 3:05. Job done.
Nice. Good
Thank
chat.
you very much. Yeah, straight through without any break. Silver is now up 6%. So it's what it gave up yesterday. What is going on with this?
It's so volatile. I mean, the thing is, it's a standard day, though, right? 5% is a standard day. So there's now you've got to readjust yourself to the volatility of an asset, right? So we used to care about a 5% move in silver. Now it's just a daily move. It's a 1 standard deviation move. So we've got to desensitize ourselves to that until the volatility resets. And You got to always look at the size of the move in the context of the volatility, right? I call it a sigma move. What is the sigma move in silver?
Right.
So the vol adjusted move. And right, this is a 1 standard deviation move in silver, so who cares?
I think this is a really important thing to finish on, right? Because if something like that has changed and the volatility of an instrument has gone up significantly, IG clients need to know that. They need to know what the vol is to size their position appropriately.
Yeah.
Because I'm looking at 6% going, oh my God, silver is going up and down 6%.
Yeah, so your position's too big. You cut the size by a third. You need to be a third of the size you were before when it used to move 2% a day.
Yeah. And that is a great way to finish because, of course, that all helps us in our risk management as well. Imran, look forward to seeing you again soon.
Yeah, for sure, man. Thanks for having me on.
One last shout on your Twitter handle.
Options_insight. Come check us out.
And come check us out next week. Piers will be back with his suntan and hopefully his sniffles gone. But of course, we can see you on the Discord, and everybody who trade live with IG will see you on the Discord as well. Thank you for joining us. At last, I can actually afford to go and buy a proper sling after 4 hours in Chelsea and Westminster Hospital last night. A massive shout out to all the doctors there. They are unbelievable. They just see people like one after another in that A&E.
Yeah, I don't envy them. But also I didn't envy you sitting there for 4 hours. Usually I sit there for 6 to 7 hours if I have to go to A&E. But yeah.
Right. Peace out. Cheers.
See ya.
Have a good week.